Wie lässt sich nachhaltiges Investieren am besten umsetzen? Wie können Anleger sicherstellen, dass ihr Portfolio sowohl eine gute Rendite erzielt, als auch die Aspekte Umwelt, Soziales und Unternehmensführung berücksichtigt? Wer ein Anlageinstrument kauft, will wissen, wo die Prioritäten liegen. Und darüber sprechen wir heute. Meine Damen und Herren, herzlich willkommen zu unserem Webinar über nachhaltiges Investieren. Mein Name ist Philippe Béguelin, ich bin Ressortleiter Märkte bei der Finanz und Wirtschaft. Wir organisieren jeweils ein ganztägiges Forum über nachhaltiges Investieren. Das diesjährige hat am 7. September stattgefunden. Und jetzt gibt es dazu unser Webinar mit 3 Folgen. Gestern, heute und morgen. Sie sind also herzlich eingeladen, auch morgen nochmals dabei zu sein. Die Informationen dazu finden Sie auf unserer Internetseite. And now I switch to English. Just before, we have asked you about your investments. The question is, what is the role of sustainable investments in your portfolio and what ESG criteria do you consider? So we would like to have a look at the results. So there is no one who doesn't consider ESG criteria at all. That's very nice to hear. And then quite a few participants have a list of companies that they exclude. And then some also have, they systematically include ESG data in their investment process. Right. Today, we will listen to 3 speakers. Andrew Howard, he's with Schroders, the British asset management company. Sebastian Schiele, he's with DWS, the asset management company in Frankfurt. And Sandy Wolfe, she's with Pictet Asset Management, which is located in Zurich and Geneva. After the presentations, there will be a Q&A session. On your screen below, if you take your cursor and you go down to the bottom, it says F&A, Fragen und Antworten. So please ask your questions there, either in German or in English, and then I will take them up, your questions, in the Q&A session at the end of the 3 presentations. But you can also already ask your questions during the presentations, and I will look at them and take them up afterwards. What you also need to know, this webinar is being recorded. Now, our first presentation is titled Amazon and the Amazon, Incorporating Natural Capital into Investment Analysis. The presentation is given by Andrew Howard from Schroders. There he is Head of Sustainable Research. Andrew is responsible for ESG integration with oversight of ESG analysts, as well as the engagement process. Before joining Schroders, he was 6 years at Goldman Sachs as Managing Director and Head of Sustainable Research. I'd like to welcome Andrew.
Brilliant, thank you so much. The first test will be getting the screen share to work. Let's have a go here. Hopefully this will work out. No shakes of the head. So as you say, thank you, Philippe. It's we've titled this Amazon and the Amazon, which is a phrase that our CEO Peter Harrison has used quite a lot in the context of financial markets. Talk a lot, and we have a clear understanding of the value of Amazon, the company. But when it comes to the value of the Amazon, there's an awful lot less focus, an awful lot less understanding, or an awful lot less, frankly, attention being placed within the investment industry on that value and the role that natural capital and ecosystem services play more broadly in the investment decisions that are made day to day. It's an area that's an increasingly important focus for us here at Schroders, and I think for the entire asset management industry. That will also change over the course of the next few years. I'm going to go through a few slides over the next few minutes. This won't be a very long discussion, to try and summarize really the approach that we've taken when thinking about the role of natural capital and to give you some of the highlights in terms of what we're doing within Schroders to try and think about the questions that it poses for us as investors. I won't spend too long dwelling on this first slide, which really just tries to put things a little bit in context, but we are a UK headquartered, but fundamentally a global organization with a relatively long history in sustainability. The point being that similarly as an active manager, we think of sustainability broadly and natural capital specifically as being a disruptive influence on the investments that we manage, a disruptive influence that is not well understood. And that as a result, it's an area in which by applying our understanding of the implications of disruptions to natural capital and the services that it provides to the investments that we're managing across all of the portfolios that we manage, this will become an increasingly important question where we can add real value to our clients through the understanding that we bring. And we do think about this, very much through the lens of all of our portfolios and all of our assets being exposed to the disruptive threats and risks that are posed by depleting natural capital resources globally, rather than simply thinking about it only in the context of individual portfolios, although obviously there are individual funds or individual portfolios where it's a particular focus. But this is also a whole firm effort, in short. To try and, again, to frame things in context, and I think one of the ways that I certainly think about this is that we've spent an awful lot of time, and there is an awful lot of focus, quite rightly, on climate change and the challenges that climate change poses, both in terms of risks and in terms of opportunities. But in many ways, climate change is a symptom of a wider challenge. And that wider challenge really is the escalating demand from a larger, wealthier, and more hungry global population constrained by finite resources. Whether we think of those resources in terms of the ability of the world's economy or the world's atmosphere to absorb carbon dioxide or greenhouse gas emissions, or whether we think about it in terms of physical resources such as energy availability, fresh water use, or agricultural land, all of these boundaries are coming under pressure as a result of that increasing demand that's being placed on them. Climate change clearly is a major part of that, but it's also part of a wider set of challenges, many of which haven't yet reached the same level of focus as climate change and carbon emissions. But increasingly, we expect that will change over the next few years as we begin to see the implications of that taking hold more widely across economies, across societies, and across financial markets. To put it again a little bit in context, if you look at it sort of say over the last 50 or 60 years, you've lost around about a third of the world's fish stocks have essentially become unviable. This is a huge change in a relatively short space of time. The pace of change here is astronomically high. The importance of action is going to only increase. And I think we're seeing similarly from the various academic work that's been begun to escalate over the last few years, the policy focus on natural capital is only going to increase going forward. And the importance of understanding that, the implications is only going to grow. This is not an academic question. Our economists similarly have done an awful lot of work looking at the relationship between economic growth and economies' reliance on natural capital and ecosystem services that it provides. The chart here really just tries to put some context to the potential implications of some of that modelling on economic growth or GDP in different parts of the world. You can see some of the numbers here, particularly in many of the parts of the world that are least able to absorb that impact, are material and significant. So this is an area, I say, which similarly is as important in terms of that top-down view. The materiality of some of these issues is becoming better understood. I think in some ways is often understated, but better understood, better modelled, and better incorporated into the way that we are looking at asset allocation decisions over the long term as part of the long-term decision-making framework that we think about in terms of which parts of the world we want to be exposed to and which parts of the world we want to better understand or mitigate the risks of. On the other hand, it's also very much an investment decision-making framework. This slightly complicated-looking chart really tries to summarize a lot of the work that we've done over the last year or two, trying to build a better understanding of which industries, companies are more exposed to the risks tied to depletion of natural capital and the lesser availability of ecosystem services within different parts of the economy. So what we've basically done here is to look at industries in the first instance through two dimensions. First of all, in terms of the dependence of an industry on natural capital, so the degree to which a particular industry relies on natural capital for business models in that industry to work, and secondly, the impact on natural capital through that industry's existence. This is very much building on work that's been done elsewhere over the course of the last few years. There have been a number of new institutions and organisations that have been born over the last few years. In particular, the Encore Framework is one that we've worked with quite closely in developing this sort of analysis, but it gives us a way of not just simply focusing on, if you like, some of the more obvious areas of the market, but really trying to understand the exposure and the risks that companies face in different economies across the market. And we think about this really as being a precursor to future investment risk, both in terms of the risks that dependency creates through a direct exposure. If industries or companies are particularly reliant on fresh water and it becomes less available, it clearly puts business models in that industry to some degree at risk. On the other hand, those industries that are having a greater impact on natural capital through the way that they're run, similarly are going to become at greater risk, both as we see regulatory intervention and as we see consumers starting to become more aware of and concerned by impacts on the natural environment. And so you have two different sources of risk which are linked but slightly different that we've tried to combine here, really to be able to map risk across portfolios, risk across industries as a starting point. What we've done subsequent to this is then to really focusing on things that are in the top right-hand corner, areas where there's a high level of risk, both in terms of dependency and in terms of potential regulatory or consumer risk. And for those industries, in turn, we've identified, I think this is really where it requires a sort of stock-specific view. We've established a framework looking at companies' levels of ambition in terms of what intention do they have to reduce their impact or their exposure, what actions are they taking to do that, how are they evidencing the progress that they're making, and really trying to distinguish between those companies within highly exposed industries that are doing more to tackle that exposure and that problem, and those industries and companies that are doing less. That in turn fundamentally comes down to a question of transition and change. And so a lot of our focus is on really engaging with those companies that are perhaps doing less to push them to do more, and encouraging the companies that have already started to continue that journey in terms of that transition towards lower long-run impacts. And the final thing that I was going to say briefly was looking again at a slightly more micro level. So that very much takes a view on the one hand from a top-down perspective, looking at the economic exposures, looking at the industry exposures, where are those risks greatest, how do we identify risks across large diversified portfolios. On the other hand, natural capital by its very definition is a bottom-up question. It's a local question, and it's one where understanding that local impact and local exposure is an increasingly important area. We, Schroders, invested in a firm called Natural Capital Research several months ago and developed a partnership with that firm to really try to understand at a very local level, defining a whole range of different assets, so species, communities, landscapes that you can see towards the left of this page, to model the flows that are created by those different assets, whether that's in terms of sequestering carbon, protection against soil erosion and so on, and then understanding the societal benefits of those different impacts. So it's really trying to take a very local, geographic specific assessment of companies. And what we're trying to do here is to on the one hand, to be able to examine individual assets, but then similarly to combine that with geospatial analysis to build up a more global view of individual companies or portfolios, where we can look at very specific ecosystem impacts in a local area and combine that with an understanding of where assets are located around the world to get a more granular view than perhaps has historically been possible. And that's, again, something that's, I think, a next evolution of this as we start to move from natural capital analysis as being a broad and general topic to increasingly being a very specific one, where some of the data and tools that are becoming available make that sort of analysis possible. So that's a journey that we're on rather than an answer that we have today, but it's very much one that we're investing in. I fear my allotted time may be running to an end, so I will pause there with my remarks.
Thank you, Andrew. Thank you very much for your presentation. Now, on to the next presentation. The presenter is Sebastian Schiele from DWS. There he is head of passive mandate sales for Europe and Asia Pacific. Sebastian looks after passive mandate sales for the regions EMEA and APAC. He has been part of DWS's passive business since 2009, focusing on bespoke passive solutions and also on passive ESG solutions for institutional clients since 2017. His presentation is called Holistic Sustainable Index Investments, Passive in the Portfolio, Active in the Voting Process. I'd like to welcome Sebastian. I think Sebastian's microphone is not working somehow. Okay, Sebastian, could you please do a reboot? And then I think, if possible, you would switch the presentations. I think he's fine about that. So we'll switch the presentations and I will introduce you to Sandy Wolfe. She's from Pictet Asset Management. She's Senior ESG and Impact Manager. Sandy joined the Thematic Equities team in 2018, focusing on impact investing and ESG integration across all thematic strategies. Before joining Pictet in 2010, Sandy worked in product management and marketing related roles at Union Bancaire Privée, Deutsche Bank and Zurich Financial Services. The presentation is titled Impact Investing with Thematic Investments. Welcome, Sandy.
Thank you, Philippe, and a warm hello to our 50 participants. So before I start to share my screen, I would like to just talk for a minute about what are thematic equities. So Pictet is managing now about 85 billion of thematic equities, and we have 15 strategies in total, and out of those we consider 11 to have a positive social contribution, so kind of an impact strategy. Now, what are thematic portfolios? The investments are basically based on long-term growth drivers, and we call those mega trends. Mega trends are long-term trends, and there we are talking about decades, not just about a few years or a few months. And those mega trends create massive changes in economics, geopolitics, or the society. Here you could talk about demographics, about the rapid technological development, a global trends towards health. So those long-term trends that change our society as a whole. And companies that can adapt and benefit from those trends should have superior growth prospects. And that's basically what thematic equities is about. Now, over the last 20 years, we have realized that a lot of those companies we invest in actually have a positive impact. Why? Because they are providing the solutions that are needed to tackle those issues. They tackle climate change, they might tackle health-related problems. Now, let me share my screen here. I hope that works. There we go. Share. Okay, you let me know if you can't see it.
It looks fine.
Okay. In the past, the term impact investing was mainly used for small project finance. And there was always this disconnect between a typical equity investor only looking for returns and between someone who was looking for impact. Now, what we have seen is that more and more investors are embracing the concept of sustainability, and there's also room for impact in listed equities. And when you look at the definition of the global impact investing network, it's not about the instruments or the asset class. They define impact investments as those made with the intention to generate positive, measurable social and environmental impact alongside a financial return. What it means is you can make a return, but you also need this intention to have a positive change in the world. Now, let's first look at how listed equity impact can work. So we have used a recent study from the Zurich University, and they have basically split impact into two different categories. So impact can come from two factors. The first one is the company impact. What is the impact a company has on the society or the environment? And here there are two main drivers. It's either through sustainable operations. And there we are in this general normal ESG setup where you look for sustainable operations. But the other one is also products and services that have a positive impact. And I will come back to this later, as this is what mainly drives thematic equities. But then you also have the second aspect of impact in listed equities, and this is the company impact. The investor impact. And investor impact can come from three axes. The first one is engagement and voting. Here it's basically about investors pushing companies into doing things better. But then investors also have an impact on the cost of capital. This could come either from the IPO or from supporting capital raises. But research also shows that companies benefit from having committed long-term investors as their investor base. So if you want to have a successful company, normally they need investors in the background that withstand short-term turmoil. And the third aspect of investor impact is what the impact management project calls signaling that impact matters. And this is about reaching out to other investors. Normally, investors are rather quiet about their investments, but here we believe sustainability-driven investors should reach out to others. They should speak up. They should also ensure that company understands that sustainable matters these days and that no one can hide. Now, this brings me back to the company impact through products and services that have a positive impact. And the question today is, how can this be measured? And first, you need to identify activities that have some type of positive social or environmental contribution. And this is actually where it becomes very tricky because different people have very different ideas of what a positive contribution means. There are a handful of frameworks out there. You could, for example, look at the SDGs that are kind of a lighthouse where we want to go. And they cover both the society and the environment, but then there are plenty of other frameworks out there as well. At Pictet Thematic Equities, we have identified those areas for positive impact. So we look at human needs, which covers everything from health, water, sanitation, healthy food, but also education. Then we have a bucket which is called environmental solutions, which is about tackling climate change, but also investing in the circular economy, investing in more resourceful agriculture and forestry. And then there is the impact enabling segment, which those companies do not have a direct impact, but they enable others through higher connectivity, through security, or through financial inclusion. And then once you have decided on what are the impact areas, of course, you need to start measuring it. The problem here is that many companies do not report detailed data. So we measure exposure to those areas as purity. So it's the percentage of the company that is based on activities that are listed here. And normally this is revenue, but it could also be enterprise value. The problem is that companies do not report detailed data on this. So what you need to do is you need to go into a deep fundamental analysis. You need to understand the companies, understand their business models, understand their products and who is using it. And this gives you an idea of what is the company's exposure to all of those areas. And then you could also think about, okay, what is the level of positive impact, but also give probably some concrete examples. Now, let me show you 3 companies. The first one is an energy efficiency company. So it's a US-based producer of insulation materials. And here we have calculated that they have 85% exposure to the theme. So they produce insulation materials and glass and windows. So all of those for higher energy efficiency. But then 15% of the company are not sustainable revenues. It's not that they are bad, it's just that they are kind of neutral. It's garage doors, it's gutters, so things that do not necessarily have a positive impact. The second one is physical security. Here we talk about a company that produces helmets and protective gear, especially for firefighters, for industrial workers. So something that doesn't have this widespread societal impact on health, but that is very important for individuals who work in those areas. And the last one is a sustainable agricultural company. It's a leader in urban vertical farming. What they are doing is they are basically using a closed loop system that can use 95% less water than traditional agriculture with absolutely no pesticides or GMO. And this means you have a huge impact, and this could really be a game changer for how we produce food in the future. Just to show you quickly how this works in practice, and I think I'm going to run out of time, so I will just capture the big points. I have here listed the examples for our nutrition strategy. And how does it work in practice for us? First, we define our intentionality. It's what do we want to invest in and why? We then look for companies that are active in those areas, and either we invest in listed companies or we look for interesting IPOs in the area. We then go for an ESG integration approach, so looking for companies and how they are running their business. Then we are very active owners on our portfolios, and in the case of nutrition, we specifically focus on engagement topics like food quality, packaging, animal welfare. We report on regularly to investors, and we also reach out. And here we publish articles, we publish scientific papers, we go out to conferences to talk to companies, but also to other investors. And our foundation also supports nutrition projects. So this is how thematic equities in total works and how we approach thematic equity with an impact. And then I hand back to Philippe.
Thank you, Sandy. Right, so now our last presentation will be given by Sebastian Schiele from DWS, Head of Passive Mandate Sales for Europe and Asia Pacific. The presentation is Holistic Sustainable Index Investments, Passive in the Portfolio, Active in the Voting Process. Welcome, Sebastian.
First and foremost, does the mic work now? Can you hear me now? Fantastic, yes. All the better. My apologies again, and thank you, Philippe, for the warm welcome. Thank you all for joining this afternoon's conversation. I'd like to use the 10 minutes for the passive indexing active in the process, in the voting process, kind of presentation to highlight 3 items that are relevant when it comes to the integration of sustainable investment practices in the passive indexing universe. And interestingly enough, we are touching on items that have been highlighted in the previous discussions, because it's all about the data. It's also about engaging with the respective companies. So what I'd like to talk about is how do we actually define objectives for sustainability strategy? Briefly touch on the data items and the data challenges that we see, and then cap off with proxy voting and engagement as how we feel about it. A very important part of every investment strategy, but all the more so for passive ESG investments. Like my predecessors, I'll try and share my screen, so you'll allow me for 1 second to find my presentation. And then again, Philippe, if you could kindly nod if you can see the presentation there. Fantastic. So off we go. Holistic, sustainable index investments, passive in the portfolio and active in the voting process. As I have promised, the journey for passive or sustainable indexing actually starts with the exposure kind of question. There are effectively 3.5 broad categories available. 3.5 because Screening, best in class, and SRI, which are familiar terms for most index investors, can be set out as investment strategies and benchmarks in their own right, and climate-related, low carbon or Paris-aligned benchmarks, again, can be individual indices, but their properties can be combined with the three previous classes as well. That's why I like to say 3.5 kind of categories. And I think that's the first important choice, because clients wanting to go with a passive sustainable strategy need to make quite a lot of active decisions and active allocations nonetheless. And it begins with the appropriate tracking error budget. A screening kind of approach with light and limited exclusion explicitly targets a low tracking error, but for an MSCI World kind of screening exposure, nonetheless, you'd need to allocate anywhere between 40 and 55 basis points worth of tracking error. 40 bips, 1 year analyzed tracking error just before Corona, 55 bips, 1.5 years into the Corona crisis. So again, a bit of budget is needed, although this is meant to have low impact. Best in class, which is very much market standard these days, where you have core exclusions, you accept a significant reduction of your universe, typically 50% of reduction in terms of market cap, for which you accept moderate tracking error. But moderate tracking error is between 110 and 185 basis points. So quite a chunk to stomach already. NFRIs is the most aggressive one. Socially responsible investments where you have extensive exclusions, a significant universe reduction, typically up to 75% of market cap removed, for which you accept higher tracking error, anywhere between 180 and 290 basis points. A Paris-aligned strategy is easier in this regard, where effectively you only need anywhere between 100 and 120 and 175 basis points worth of tracking error. But that's the first starting point. If you want to begin your journey for ESG investments and passive, the question is, what kind of strategy would you like to implement and how much budget do you have? The second important question to discuss is about data and measurability, as we have heard in the two previous kind of conversations. As soon as you want to implement a passive ESG strategy, you also need to think about what data providers you can use, what data points you would like to use. Because typically, if you develop or track an ESG index, you're also married to the index provider's household provider of ESG data. So an MSCI ESG index will always have MSCI ESG data, which you need to understand and be comfortable with. And that's a relevant piece of information, because there is no homogeneous understanding and no homogeneous set of data and definitions for ESG for the time being, where MSCI, for instance, look at a company with high personnel turnover and assess what's the impact on the bottom line. Is this a brain drain that could impact the valuation of the company? Whereas ISS Ökom, now acquired by Contigo, look at the same kind of data and assess that maybe this is a bad place to work. So data providers and data model choices also impact your investment strategy. As the third kind of relevant piece is then really themes when you want to invest. We have sponsored a number of studies through Create Research, which we have recently published our 4th iteration, the impact of passive investment for institutional investors, this year looking at the social pillar. And we found the social pillar particularly relevant because governance as the G aspect in ESG has been around for quite some time. And not only because of COP26, climate investing is a very current and very important topic. But the social pillar as a third example and third aspect of ESG and sustainable investment for the time being is not necessarily that much deployed in clients' performance. So as part of this study where we effectively talked to 140 pension funds and had 40 detailed interviews, we figured out that if you wanted to invest in the social pillar, what are the most important clusters that you want to target? And by a wide margin, 66% responded that employees are the sort of cluster within the social pillar that is regarded as the most financially material. But those clients struggle to identify how they actually would measure the employees aspect within the social pillar. So data and definitions are notoriously a problem or something that is inhibiting the wider deployment of the social pillar as an investment. And I'm bringing this specific example because for the time being, clients and investors then target the social pillar through other means, broader ESG themes like a standard ESG index that covers E, S, and G combined, or overarching aims, for instance. And overarching aims include, for instance, the integration of governance activities, of corporate actions, of engagement, which we have talked about as stewardship kind of abilities. So I said 56% broader themes, 50% overarching aims. That is, they try to target the social pillar through other means. And those other means are, I think, extremely relevant because we also assessed our clients, how they target their partners, how do they select an investment manager, an asset manager for their passive ESG and social allocations. And I think that's sort of the segue into our third and final aspect, that is the corporate governance venue. Because the overwhelming majority of clients responded, 2/3 responded that as a selection criteria, important selection criteria, they look at the capability and track record to fulfill a client's ESG or social agenda. So the understanding of the data and the ability to implement. But as the second most important aspect, 63%, it's about the stewardship and the proxy voting track record. So they appreciate that ESG investments, and in this year's study, particularly the social pillar investments, need to be complemented, should be enhanced through a robust stewardship and proxy voting framework and abilities. Interestingly enough, fees and charges only came in as fourth place, which is a bit of a surprise if you start talking or if you start thinking about low-cost passive allocations. So with sustainable investments, it's more about the capability and more about the track record than is about the low-cost kind of implementation. So as I was just saying, the stewardship and the proxy voting aspect are an important criteria for clients. And proxy voting is so important because it is one way to address the shortcomings of data, available transparency that is continuing to improve, obviously. But as said, proxy voting can be done and is important, but there are various ways of doing proxy voting and engagement. One particularly important way of supporting sustainable investments is what we like to call a qualitative kind of process, something that supports what we call narrative engagement. So I'd just like to illustrate how we feel about the stewardship process that typically is following a very transparent framework, transparent both for our clients and the investee companies, that begins by setting out our objectives for the year at the beginning of the year, which obviously is followed up by typical conversations, engagement conversations through meetings and calls. But what is important, an asset manager must not hesitate to escalate if companies fail to take the meetings, or if they take the meetings but fail to work with our objectives. So we as a European asset manager have a critical but also very constructive stance where we actively participate in AGMs and raise our concerns publicly, which is a very important leverage to get our position here heard. But we also don't hesitate to vote in line with our policy against management and board of directors recommendation. So that's quite the escalation, if you will, which again is something that we're being very transparent about, because we of course send out post-season letter to individual companies where we explain our narrative and our rationale to vote. But escalation, I think, is a very important aspect because that's why we do the stewardship approach to begin with. We have passive investment strategies, but those require quite a number of active decisions how to structure your strategy. And as active are we in our stewardship and proxy voting process, because this is only one additional item to support a sustainability investment strategy, not just in passive, but here it's all the more important for its rule-based nature. Philippe, I think I've just met my 10-minute mark, so thank you very much indeed, and I'd like to hand it back to you.
Perfect, thank you very much. Now, ladies and gentlemen, if you have any questions, please write them down in the F&A section. You find it at the bottom of the screen with your cursor. My first question goes to Andrew. You talked about disruptive threats, about risks. I think they concern the whole portfolio, the core portfolio as well. And then you said you look at asset allocation globally, across geographies, across industries. Would you have an example, either a region or an industry where you want to be exposed, or where you want to be not to be exposed because the risk for your portfolio is just too big? I think your microphone is off.
Sorry, that's me being too cautious, double muting. I'll try and think of an example here that sort of played out a little bit over time. So broadly speaking, one of the within any, it's always difficult to separate risk and opportunity. I think in many ways what we're talking about when we think of the word disruption is there will be a threat to companies within industries. Those companies that can navigate that threat will be relatively better placed, and those companies that can't will be relatively worse placed. So one of the areas that we've looked at is around carbon intensive industries and water intensive industries, and in particular manufacturing, where you have oftentimes in global industries, and the example that's coming to mind is a packaging company where a couple of years ago, probably about 18 months ago now, there was water shortages in parts of northern parts of the US, which basically led a particular manufacturing plant, which was a large player, to be unable to continue operating. So there's a fairly clear cost, both in terms of lost revenue, but also in terms of the cost of having to shut down that manufacturing plant for several months as a result of not having access to fresh water in that part of the world. The consequence of that, given that it was a fairly concentrated industry, was that other companies within the same industry benefited without doing anything in this particular case. So in some ways, the fact that there was this price response to a lack of supply in one part of the world created a benefit to people in other parts of the world that in this particular example just happened to be in the right place. But equally the same logic applies, because happening to be in the right place is in the long term a strategic choice as well for companies, as well as in terms of how they think about running their business. So there's certainly, and I think water is probably the area in my mind where this becomes most obvious. We've seen similar things if we think about other water intensive industries. The aluminium industry very famously had a number of disruptions when water availability in parts of the world that was firing hydro plants basically meant that aluminium producers weren't able to keep operating. Water is probably the one I would say, in my view, if you look at parts of the world where water tables are dropping very rapidly, it is an area where those disruptions have already started. In some cases, they will be short-term disruptions. In others, there'll be longer-term disruptions. Agricultural ability to continue growing food will increasingly come under pressure in some places. And so in all of these cases, you've got winners and losers from the same events. And I think that's really what we're talking about. As those events become more frequent, it really becomes important to understand who's exposed to those risks and who's managing those risks, in order that the same events, the same issues, the same trends create both the winners and the losers that we really want to try and understand now before that plays out rather than afterwards.
Right. So is it correct to assume that obviously you look at the risks for the whole portfolio, like for example a pension fund who has to protect his assets, and so your main focus is on these risks, and it's a different thing, as we have heard before from Sandy, for example, if you want to have a positive impact, saying that you want to try to help a little bit to change the world. Your main focus is on the risk.
So in this conversation now, we have a couple of funds. The reason I'm framing it that way is because Schroders, we manage $800 billion of assets. We have launched a few funds which have collectively got like a couple of $1 billion in them, but are growing very quickly, to be honest, and are performing extremely well, which focus much more on the how do we find the companies that are providing the solutions. And it's probably among Sandy's sort of options, probably we've tended to focus a little bit more on the enablers bucket. If you like, in terms of where capital's flowing, we have done some work in those areas, but I think our starting point, really, you're absolutely right, is more from we need to think about this at a macro level, as well as at a sort of micro level. But the macro level is the bit that fundamentally is the key thing to get right across the business.
Okay, thank you. My next question goes to Sandy. You explained us about impact investments, where people want to have a positive and a measurable impact. How do people or clients incorporate that in their portfolio? Do they look at their whole portfolio, or for some maybe it is more like a part of their portfolio satellite, where they want to have some impact, but they still have their core portfolio, maybe where they can't have impact investing? How does this play out?
Yeah, so but what we see is for institutional investor, it's often still like a core satellite approach, where those impact areas are more something that you have to do because their own investors are asking for it. We see it increasing now. I mean, strategies like water or environmental solutions, we see a lot of demand. Why? Because they are globally diversified strategies. So nothing prevents us or investors to use this as a core allocation for their global equities. On the other hand, we do have a lot of retail private investors. And for them, it's completely different because thematic equities, it has a very tangible feel, right? You can imagine what you invest in when you have a nutrition fund or a water fund. You know kind of the companies, and when you invest in smart city and you sit in a tram in Zurich and you see that's Stadler Rail, you kind of have this personal connection and you see also what the impact of those companies can be.
Okay, you explain also how difficult it is to get proper data and that you need your own research. Are there any ESG ratings? I mean, there are many ESG ratings, but are they useful for impact investing, or is it just you need an additional research because there is no ratings that you can use?
So it's a very complicated question. I mean, there are a lot of ESG data providers out there, and it's getting more and more basically every day. The problem is the correlation between those generally is very low. So you might find one ESG data provider that gives the highest rating for the same company, another a very low rating. And what we see is the ESG data providers, it's sometimes good to check on how the operations are doing, but then for the impact, you really need to look for those companies yourself. And it's something we need to get used to as investors on the financial markets. We are used to data that is standardized, that is audited, that is repeatable. For ESG, you have a completely different set of data coming in. Estimated data that depends on your own moral compass, on the culture you are coming from. So there, I think it's really important to have your own view and then to find the data that you need in order to build portfolios.
Okay, thank you. Sebastian, you mentioned the interesting term tracking error budget, meaning how much risk someone can take as opposed to the benchmark. How important is this really, or isn't it more important to look at the long-term performance as well? Because there might be a tracking error in the short term, but for investors, it might still be a good investment that is long-term, that long-term has an outperformance.
Well, that admittedly really depends on the client. And when I say on the client, it's also a question of domicile type and region, if you will, because admittedly, and Stanley has just put it quite succinctly, I mean, ESG investing depends on your own understanding and your own moral compass. But it also depends tremendously on regulatory drivers and requirements, for instance, and if you're a pension fund, on your members' objectives. And it does make a difference if you're talking to a German pension fund, a Swiss pension fund, a Swedish pension fund, an Australian pension fund, because they're all in a different parts in different areas of their ESG and sustainability story. So some of those clients, specifically if you look at the Nordics, have been very intensely gearing their portfolios towards sustainability for years. So they don't mind applying a large tracking error budget. But if you look at the smaller Swiss or smaller German pension fund, for instance, conservative now begin to implement ESG at portfolio level, but effectively just want to dip their toes. They're more focused on the tracking error budget, and they want to have it as small as possible to have no explanation risk to their board and to their members. Why did they make an active call to integrate ESG while their objective is basically just to deliver MSCI World returns? So on your question, it really depends, but as soon as you want to integrate ESG in a portfolio, you need to take active share, that is active deviation from your original benchmark. Otherwise, you cannot integrate ESG. Otherwise, you cannot improve on particular ESG objectives. So quite succinctly, as you put it, tracking error is sort of a short-term risk measure. But if you want to have sustainability in your portfolio, you need to allocate some budget to stomach it. A good rule of thumb is typically up to 1% for developed markets, and MSCI World kind of preferred it for an advanced ESG strategy, up to 2% tracking error for MSCI emerging markets, if you want to deploy a more advanced ESG strategy in a passive context.
Okay. You also explained about stewardship, how you think it's important to vote as a shareholder, and that you have a qualitative approach there. Is it possible in any way to measure this? Because usually people want to see some kind of data or comparison or so, or is it more like you have your approach and then you try to get the most, to make the most of it?
Well, there are two ways of measuring it, but what you're alluding to is obviously correct. You can't quite put a percentage per figure of performance or outperformance on our way of engaging, of our way of doing stewardship. But I think two measures are really relevant. The first is our take is really a long-term narrative kind of engagement. Narrative engagement means you engage with the company, you agree on measures, and you follow up the following year to see if they have actually improved in a way that they have promised to do so. So long-term kind of engagement rather than, say, an activist kind of take, if you will. Just go in, try to change something and go out. So long-term relationship, long-term engagement approach, where there are quite a bunch of studies to illustrate that this longer-term approach to engagement is certainly beneficial on the economic impact of the companies. And the second is really, I mean, our voting behavior and our engagement behavior is fully transparent. So the other way to measure us really is in our behavior. We're extremely keen on climate-related proxy votes, for instance, where we are historically in the high 90s, 93 to 95% votes typically in favor of climate-related resolutions, as long as they are transparent, tangible, and measurable. We're also regularly voting against management proposals, typically in 24 to 25% of all cases, because typically they are not transparent enough, they are pay related, but don't have clear KPIs, or it's directors related without a clear qualification, or too many other jobs, too many other occupations, so they can't concentrate on the company. So there are certainly objective measures of what we do, and that's and how this benefits the companies that we engage with.
Okay, thank you. Now, maybe as a last questions to each of you, if we look at all these difficulties with data, with benchmarks, with regulation as well, would you have a wish? Is there one, as an example, one specific, either a benchmark, data, a financial instrument, or a kind of a regulation that you would wish for that would help you to do your work? If you could ask the regulators or some other supplier, Sebastian?
Well, I mean, again, I'd like to borrow from Sandy, because this heterogeneity that we currently see in ESG data is certainly something that is an opportunity, but also makes it difficult. I mean, we at DWS, we embrace the diversity that we see across the vendors for the time being, because there are different risk signals to us. But it's also more difficult to explain if and how a conclusion is reached if you have conflicting and differing kind of signals, if you will. So more ESG and sustainability related non-financial disclosure for more companies, including smaller companies, and a more consistent framework of how this can be disclosed, I think is very high on my wish list, if you will, because it makes our lives more measurable and more easy again.
Andrew, would you also have a wish?
At the risk of being slightly controversial and taking a slightly nuanced view to Sebastian. So I fully agree with the same challenge. I think that the regulators are focused a great deal on outcomes and consequences in terms of what you have to measure, whether that's in the EU, there's a big focus on something called the taxonomy, which is an incredibly precise set of definitions around what constitutes a green activity. And they've done that before they've created the transparency around the company reported data. And I think there's a real headache. I would love to see more standardized and better reported company level data. And ironically, I think we will inevitably see, and I think this is a good thing, more variation in how that data is used by end users, whether that be research firms, rating agencies, or asset managers like ourselves. And actually it's creating the standardization of the raw material and allowing the innovation in terms of how that raw material is used. For me, what would be important. This may be very much an active manager perspective on the problem.
Okay, and Sandy, please, your wish.
Yeah, I agree with Andrew on this. So if I had a fairy godmother, I think I would wish for more company reporting, more standardized company reporting, but then also reporting on those little things like what are their clients, what are the products they are producing, where the raw material coming from. And we see more and more regulation coming, but in a way it's sometimes over-regulated. So you get so much data that it cannot be useful anymore. And on the other hand, companies often lay back or just say yes, but we have reported what is legally necessary, and now you just deal with it. So some more common sense based good reporting by companies, that's something I would like to see.
Some more common sense. That's very nice. Ladies and gentlemen, thank you for your attention. Tomorrow at 4 o'clock, there is another webinar. If you would like to participate, please go to our homepage. And thank you to the participants. I wish you a very good evening. Good night.